Are students looking to get higher education about to get unbelievably unlucky? Last year, the One Big Beautiful Bill Act implemented a new federal student loan cap that's slated to take effect on July 1st, 2026. And while these specific caps will not be affecting federal student loan programs for undergraduates, the law eliminated Grad Plus loans and imposed an annual borrowing cap of $20,500 for graduate students and a total lifetime cap of $257,500 on all federal loans. Well, there's been a rule change, so today we thought we'd take a look at this policy, what the hidden data implications are behind it, and what the F test is going on. Hello, and welcome to Off Significance, a podcast to make you feel smarter than other people, because hey, you already are. I'm your everyman host, Brent right here, with two experts who knew about big data before it got big. One who thinks the only cap that should be on is baseball game attendees, Dr. Nathan Woods, and the other who will tell you how it is no cap, Dr. Steve Bronars. Nathan, Steve, how are you?
Oh, I'm doing so great. Thank you.
Doing great, Brent.
Did you pick up my hip young lingo? Did you understand no cap, no cap?
The reference to the F test?
No cap, no cap. Means truthfully. Okay. Also with us is Connor Moynihan, a managing principal at Edgeworth Economics with expertise in statistical and economic analysis involving both antitrust and labor and employment issues. His practice generally involves applying economic concepts to litigation and damage topics, such as those involving price fixing or monopolization claims, discrimination issues, or restrictive covenants in employment. Connor, welcome to the show.
Thanks for having me, everyone. Brent, Steve, Nathan, happy to be here.
Before we start anything, I could use a loan. Could you just you got like $50 and we'll pay it down over the course of 30 years or so.
It's a pretty steep interest rate, but I have $50 that you can take.
Okay, so let's get into it. Suppose I am an aspiring grad student and I can either get a loan on June 30th or July 1st. What would be the difference in my perspective as a borrower?
Yeah, so if you're enrolling now after July 1st and applying for a loan after July 1st, these new loan caps will go into effect. I think for one clarification, a final rule hasn't been issued yet, so things might still change depending on what field of study you're going into, what university, how much you're borrowing, what type of loan mechanism you're borrowing through, et cetera. So at the end of 2025 and January 2026, the Department of Education issued this new rulemaking proposal, I should say, which there was a comment period, and now we're waiting to hear back on the final actual rule, turning the rule proposal into a final rulemaking authority. So as part of that, I think some history on how things have worked previously is helpful. So for graduate students specifically, applying for Grad Plus loans, which is the standard type of loan disbursement you'd go through as a graduate student, you could borrow from the federal government basically up into the cost of tuition. There were previous restrictions on how much you could borrow for undergraduate student loans, and certain types of loans for parents of students attending university. But at least in recent history, for graduate students, you could borrow up into the cost of attendance. Now, what the One Big Beautiful Bill Act is doing through this, they like their acronyms, the Reimagining and Improving Student Education, I think it's called, the committee, are basically defining new restrictions on the amount of the loan total and the annual loan amount you could receive for attending a graduate program. So what that is,
I kind of feel like what's the acronym there? Because
RISE, RISE, okay. Reimagining and Improving Student Education.
I have it such a hard, I feel like a dog when your parent, when the owner is trying to spell it, do you want to go OUTSIDE? Should we take him to the PARK? I'm like, I don't know what he's spelling. What is he spelling?
Is that Pig Latin?
Yeah.
I thought it was kids. Dogs.
Yeah, because you can't say that. You can't say like treat or outside. They'll freak out because they've heard that word. And I guess kids are probably a better example. Anyways, you were saying.
Yeah. So, basically, now there'll be total loan limits and annual loan limits for what graduate students are able to take in federal student aid. So there's private options, but this is for federal student aid specifically. And what's really kind of grabbed people's attention, and which people may have seen in the news, is I'll put graduate students in air quotes because there's two distinctions they're making. One is what they are calling graduate students, and one which they are calling professional students. Practically speaking, there's not actually much meaning to those words other than defining two separate groups of different programs or fields of study that people can go into, which will have different limits on the amount of loans they can take out from the federal government. So for what they're calling graduate students, which is the bulk of programs you could go into for a master's degree, a doctorate, a professional certificate, they have lower loan limits of $20,500 a year or $100,000 total for your graduate education, versus professional fields of study, they're calling them, which are more or less fields of study that historically have needed some type of licensure or larger investment in education to practice in that field, things like medicine or law, where you can take out $50,000 annually or $200,000 total. So double the aggregate total, a little more than double the annual limit. And one of the reasons why that's catching people's attention is there's obviously a lot of students going into graduate degrees that might need more than $20,000 per year in aid if they can't afford to pay that money themselves, or more than $100,000 total. Likewise, limits can apply to the higher totals too. Some doctoral programs cost more than $200,000. And so people will potentially need to look to other avenues of aid to sort of pay for that.
So what gets counted in the professional category?
So I think there's 11 fields of study that they've included in that, and they're sort of broad, but it is medicine, law, theology, chiropractor degrees, and then a set of other sort of, I would call them subsets of medicine degrees. So podiatry, optometry, dentistry, things like that. So really, it's medical fields, and then law, theology, and chiropractor. I'll leave it up to you to decide whether that's a medical field or not.
So if I was getting a nursing degree, that would count in?
That would not, and a great clarification. So nursing actually is one that was left off of that professional categorization. There has been, I think, both nursing associations and lawmakers that have written in the comment period for this proposal, basically arguing for the fact that nurses should be included in the professional category. Whether or not that's going to happen, I think we'll see. Right, we haven't gotten a final rule yet from the Department of Education. No, nursing is not included in that professional category.
So I guess my first question about all of this is there any good reason to differentiate these two categories? Is there any economic sense behind why you might offer higher loans for one or in caps for the other?
Yeah, I think that, one thing that you would want to look at, that if it was a private lender, they'd be looking at is like, are we getting a lot of defaults on this? Are people able to pay the loan back? And it seems like that could depend on not just the degree, but the institution granting the degree. And it's interesting, Connor, as you go through these different fields, in a lot of fields, it's like you could get a master's degree, you could get a PhD. There's different kinds of support that you might get from the institution for each of those. But like certainly a PhD is going to take a number of years. And so I don't know where the loan money has gone. I would imagine it's gone more to people in the master's programs than the PhD programs, where they probably have research and teaching assistants, so they're not taking out quite as much. I mean, everybody goes into debt to some extent, but I would think that it would be the thing that you want to look at is like, are we getting paid back, or are we essentially subsidizing some of these fields, some of these institutions, because they can't afford to pay us back, they default, and somehow that gets settled in some way. But I'm not sure that's what they're looking at here.
Yeah. Well, it seemed related to that. It seems like if there's an interest on the part of the federal government or the taxpayers, whatever, to incentivize getting into certain fields, like that could play a part as well. And it doesn't seem like that has anything, theology, accounting. Do we need more lawyers?
Do we need more chiropractors? Or
but obviously where you draw the line is going to be important. But it seems like that point that Steve made is really important. But also, if we're going to start thinking about this stuff, what do we need more of? And shouldn't we be focusing our efforts on those things?
Yeah, and I think to Brent's earlier point of nursing being left off of the professional categorization, I know that's one issue that's been raised, is there is a nursing shortage, generally speaking, and specific nursing categories too, like nurse anesthesiologists, and nurse practitioners that are potentially short in supply. And so from a policy perspective, do you want to incentivize more people to enroll in those degrees?
So what motivated this change in the first place? Why adjust the graduate program? Why not adjust all of it? Why set it to the levels that we've set it to? Or we're potentially going to set it to?
Yeah, so I think it's an involved question.
Thank you.
So I don't know that I will hit every part of it, but I guess to set the stage, right, is how large is the federal student debt portfolio does graduate degrees comprise, right? Most people, when they take out debt, they do it first take out student debt, I should say, do it to attend an undergraduate program, which is the vast majority of the federal debt portfolio. So I think, broadly speaking, you might think that graduate student debt is actually not that impactful to the outstanding federal balance. But I do think there's another layer to that, which is who's repaying their loans in what amount, and where are people defaulting on them, and where does the federal government give relief to people's loans too. And I do think there's some prior work that's been done looking at whether graduate students take out larger amounts of debt, even though it's smaller in total, and more of what needs to see relief from the government, or where they can't repay it, might happen for graduate students. So I do think there's some rationale for targeting graduate student loans specifically. But that's a deeper question to look into of what is actually comprising outstanding debt default in the loan portfolio.
And it seems to me, and this is part of Steve's point earlier too, that's going to vary so much depending on the institution, and so not just certain categories of degree and area of study, but what school are you going to? Is it a legitimate place, or some kind of for-profit university that may not exist any longer?
I think another issue that relates to this from the point of view of the university over time is I wonder what's going to happen to. It's my sense that I haven't seen data on it, that foreign students come and they're paying more for their education, whether at the undergraduate degree, graduate degree. And so you can kind of look at the Department of Education statistics on how many graduate students there are, but some of them are coming from all around the world. If that inflow reduces a bit, and that's a big revenue source for these universities, it's going to be harder for them to offer as much aid as they might be doing right now for some of the students, because you're going to have to get the money from somewhere. You have to get through graduate school and pay your bills, and it's a huge investment that you're making. And so the question is, if the federal government doesn't loan the money, will people just not get the degrees? Will private lenders step in? Will the universities figure out some way to provide more student aid to keep the size of the departments and the programs as large as they were before? I don't know.
And back to the policy perspective is, are you disincentivizing, domestic enrollment for domestic students who are able to get federal aid but now can't? To the point on how much of the student body is comprised of foreign versus domestic students as well. And then I think back to Brent's original question of, what's the motivation of the bill in total is, right, there is a large amount of student debt in total. And some of that may be coming from more students going to college. Some of it may be coming from the cost of tuition going up. So, my understanding is some of the impetus of the bill and then this provision of the bill is to try to rein in rising university costs, which again, I think is an interesting question, whether this will effectuate that, or will it have other outcomes? For example, shifting student bodies towards those who can pay without federal aid.
I was thinking of another issue that you see some figures out there, but I don't see where it's supported, and that is that people who are just graduating from college, struggling to find a job, higher unemployment rate, and not getting a job in their field. I'm not sure if it's that much different than it was before. And, one of the ways to try to respond to that is like, well, I'll get a graduate degree, I'll get a business degree, I'll get a law degree, I'll get a master's degree, whatever it is. And so I wonder how much the labor market, even though I understand we're talking about separate things, the graduate loans versus the undergraduate, but maybe people are thinking what I need to do is get even more credentialed, more education, and that could be taking a situation that was bad and making it worse because they're going into more debt. But again, I think you'd have to do a careful study to see how much that's really the factor.
What is the, I mean, just in general, what is the default rate on these? Is that a widespread problem? Because it seems to me, and I should warn you guys, I watched The Big Short last night with my son who's taking an economics class. And so I got a lot of Big Short on my mind.
Sure,
and
yeah.
we'll get later whether or not we can take bets against
you're
the
thinking
loan
about like,
market
oh, what
for-
can we do with this Jenga tower?
exactly right. But you know, is this like a big problem with the defaults, or is that kind of an overblown thing that's probably focused on certain of these institutions and sure a handful of majors that are not working out for people?
I think the rate of default is probably higher than most people think it is, but I also think there's some distinction there. And this goes into, I think maybe we hit a little bit on like the economic incentives of loans for the lender, for the government giving out the money, but what are the economic incentives and what should the borrower think about? And one thing that's important in this is the repayment plan that you're on. So I do know there's high default rates on people that are on income-based repayment plans. That's essentially a set-up payment plan where you can pay back your loan at X% of your income for 20 years, or there's a variable time period, but let's say 20 years. And after that, the government will give you relief on your loan. So as long as you pay back enough at a certain time interval for enough time, then after that, I mean, it's a little different than defaulting on your loan.
Mm-hmm.
It is approved relief for your loan, but then you'll pay it back. So I think that's like one category that I know has been a point of focus, especially for graduate degrees, where you are taking out more money for programs that last more years. And so people will take out these large loans and pay them back over a long period of time, as much as they can, and then allow the government to give them relief after a certain amount of time. This is a report I have from 2021, I believe, from the Bipartisan Policy Institute. And this says before the COVID-19 pandemic, 11% of the total outstanding federal student loan portfolio was in default. So that's where I say I think it's maybe higher than you might guess. 11% to me sounds relatively high. 1 out of every 10 students is defaulting on their loan.
I guess maybe I might need a clarification of terms, because if you're defaulting on a loan, does that mean that you have stated you will not be paying back any more of that loan? Or if you have a delayment of payment over a certain period of time, is the loan fully defaulted?
Yeah. So if you're in delinquency of your loan, that is the day you miss a payment.
Yeah.
Nothing happens then, but you're in delinquency if you're late on a payment. That's just 1 day late. Default is 270 days afterwards, and collection starts. So when you're defaulting on a loan, you don't want to do that. Collections are starting. That is going to a collection agency, I believe. And you there's relief programs, again, like if you're going into default, you can enter certain relief programs, but they may hold your income as you're in default on that loan.
How about debtor's prison? No,
debtor's prison.
It's just a loaf of bread, Steve.
I know. I think that 11% is one of the figures, and the other one would be how much you owe, because presumably it's enough that you're once you've reached that point, it's like underwater here, and I don't see a way out. So it's probably also an amount that's enough that this would matter. Not just you're down to your last few $100 and you can't pay that back. So I think that is a serious issue there.
Yeah, and back to what should students consider on the economic incentive of taking out a loan, and it's something that maybe not everyone considers, is how much of your monthly paycheck after you graduate needs to get allocated to go towards paying off that loan, and it's more than some people might expect. I think a standard is 10% of your disposable income, say, going towards your student debt payment is pretty good, but that's not that much if you don't earn a lot after going into a lot of debt. So it's dependent on both your earnings afterwards and the debt you take out, right, will affect how much you're going to have to pay off and how much you have to pay per month, what you can afford on a monthly basis. So yeah, I agree that, how much debt you're going into default on. Hopefully most people don't get there. But I don't think it's necessarily not just once you default too that they need to consider, but what's the standard of living you want on a month-to-month basis, having to pay back a fixed monthly
right. And I think
loan.
for the also a very large investment that people make, I'm going to buy a home, I'm going to buy some property, there's an appraisal and they're kind of looking at that, and you can get turned down because they're like, you can't finance enough of this yourself, you want us to loan the money, and even though there's something we could repossess if you fail to make the payments, we're just not going to go through with it. And the tricky thing about in these economic markets like this is that the riskier it becomes, one way in which you would deal with that is, well, we'll just charge you more in interest because it's riskier, but that makes it even harder for you to pay it back. So in these kinds of markets, the only solution is to say no and to cut it off or limit the amount that you would loan someone, not saying, well, we'll still give you the full loan, but since it's riskier, we want to get, an expected return that compensates for that risk. So we'll just jack up your interest rate. It's like that's self-defeating. So it is a situation where these kind of restrictions in other lending markets are going to come in and they're going to say, nope, cannot make that loan because there's no rate that we could charge you where we would feel comfortable with the risk that we're taking on and we think you could pay it back.
I think about when I got my student loans, and I think about when I got my mortgage. And when I got my student loans, they probably included, whatever bank I went to, they probably included some table that showed out the monthly amount that I would be expected to pay.
Thanks to the CFPB, but before that, forget it.
So I might not have even had that. But even if I did have access to it, I was not paying attention to that the same way I was when I got my mortgage and realized, oh boy, this is expensive.
Yeah. You didn't do a forward-looking interest calculation.
So I guess I'm kind of curious thinking about, people who are making the jump to invest in getting this graduate education. Surely by lowering this cap, you're going to be deterring some students from getting a loan and they're going to be less likely to default as a result of it. But potentially there are other students who, maybe they're rolling the dice and they would be more productive. Because it's such an uncertain thing that they might actually truly benefit from it. How do you make sense of the downstream effects of this change as people are going to more private lenders and any of the other consequences as a result?
I mean, I'll start with one, which is what we were just talking about, which is if you go to a private lender, and I forget exactly the current federal rates, but you're getting something between a 5 and 8% interest rate on a graduate student loan. If you go to private lenders, it's going to depend on probably your credit history and your ability to pay back and the job you have before. And if you're coming out of undergraduate without prior work history, the type of private loan you would get is going to vary depending on the type of student who's going back for a graduate degree. You may get a better interest rate from a private lender than you would have gotten from the federal government. I'm not sure on that. But you could also get a worse interest rate. So I do think it may depend on who you are and what you can get from a private loan. If you cannot get the full amount of tuition from a federal loan,
I think there'll be more part-time students, and they'll be working their way through night school, is what they used to call it. Just taking a job, and I'm not sure that it's a job in a consulting firm. That's probably a good idea. If it's it may not be the best use of your time. It's always one of these interesting things. If I could get out with this degree, the amount that I would make per week is so much more that I can get while I'm working my way through school. Just from the pure economics of it, it's like maybe that's not the best way to allocate your time. Get through, get your education, get your credentials, your training, and then when you come out, then you can pay it off. But I think people are going to be saying, well, if I can only borrow this amount, maybe I have an option to only take a partial school sketch, and when I'm not in school, I'm working my way through school. Nathan, what do you think?
Yeah, I think that makes sense. And then I think, not to over romanticize the graduate student experience, but, I think there's something about being fully invested in that training and that learning that is not the same if you are working a day job and then taking a class here or there. as you're working through. So, and again, that'll depend a lot on what you're doing. But yeah, I mean, that seems like a reasonable possibility. I don't think that's a good one. I don't think that's what should happen.
If that does happen and people still go to school and universities still have the same enrollment, people just do it over more years because they go part-time, will that have any reduction in the cost of tuition if they have the same amount of people attending? Maybe if part-time enrolling is cheaper, but
no, I'm not sure that in the big picture it achieves thing, but I just think for some people that might be an option. And I think, depending on the kind of degree and the time period we're looking at, I think that's how some people, got there. And there's executive MBA programs. My dad got his master's degree. He was a teacher and then a principal while he was working and had a family, and he would go off to school, and it happened.
As I said, Brent, to your point on students going to graduate programs to better themselves too, and maybe understanding they can make more afterwards. That's also something the government can incentivize. If you make more and you improve the income of the residents, that is also potentially more tax revenue because people have higher income, better jobs, people investing in better businesses. So I do think there's also an outcome there of what are you disincentivizing if people aren't going and taking graduate programs? Sort of the deadweight loss of the people who don't go rather than the people who seek private loans or go part-time. There's a portion of people that are potentially left behind and don't attend graduate school.
I don't know if this is going to be relevant, but I had a long conversation with a financial aid officer for an undergraduate program the other day. And what I learned was the qualifications to get federal aid, which obviously is limited in a lot of ways, are very different than the qualifications to take out a private loan. So for federal aid, they run a credit check and that's it. But for private loans, they're not only looking at doing your credit check, but also looking at your debt to income ratio, which I think would disqualify a huge subsection of people who would potentially be interested in pursuing higher education.
Debt to income ratio is a hot topic.
Why? What's a hot topic?
I say that's a hot topic in two ways. One is that I'm interested in it and that it's something to consider.
And if it's a hot topic for me, it's a hot topic.
I love that logic.
So circling back to the core of the issue that we're talking about, which is the caps on student loans. One issue or qualm people have had with that is with a somewhat arbitrary nature that seems in applying these two types of categories, graduate students and professional students. Why were nurses left off of the professional student list? Why were accountants left off of the professional student list?
Or in either one of those categories, why are they treated the same when there's probably all kinds of variability inside each one, right?
Exactly. And so if you're an accountant, let's say from a good university like Stanford or Columbia or Cornell, your debt to income ratio is maybe much better than some other degrees that are getting categorized as professional. And maybe you're taking out more loans, but you're also subject to getting a much higher income after graduation. And so the reason I say that debt to income is a good topic to bring up is it is one metric we can use as economists to evaluate whether someone would be a useful investment. And I hate to sound so objectifying there, but is someone a useful investment for a loan based on the amount of the loan they were going to take out and the amount of income we expect for them to earn afterwards? So for a nursing degree or an accounting degree, you may want to look at, well, do they have relatively good debt to income ratios? And is that a way to potentially rationalize their potential inclusion as a quote unquote professional degree for access to higher loan limits?
Were you apologizing for sounding like an economist there? Is that what I...
We don't get enough of that on this podcast.
I hear my own voice back in the headphones, and so when you hear it in real time,
that whole debt to income ratio thing, it's just too dry. But yeah, he's apologizing, Steve. What do you got?
No, I think that that would be one of the many things that they would look at, and I think, as Kim said, that for the private loan, they're going to look at that, and it would seem logical then for a loan that taxpayers are contributing to, like maybe they should look at that. And, that doesn't mean that you shouldn't go ahead and try to get that degree if that's what you really want to do, but you should be aware of the idea that other people think you're going to struggle paying this back and factor that into your decision making.
I guess it's weird to me looking at this bifurcation of who's getting what loan amount, that it's split into two big buckets. Is there a better way to think about how you might categorize different populations who are trying to get loans? Because I could easily see the argument we need to reduce the cost of higher education. The federal loan amounts are too high. Why is there one special group that is still able to get whatever full amount that they basically want? Right? It seems like there's a lot of factors here. You're not targeting the main issue, and you've got these really big categories that obviously have a lot of differentiation underneath.
Yeah, and I think one thing the government would probably say, and I think they've said in their announcements, is a lot of graduate degrees don't need higher loan limits, which I think is fair in some cases. A lot of degrees are only a year long if you're pursuing a 1-year master's degree. So I do think there's a general question before diving into whether there's other ways you could categorize different people. There are some people who don't need higher loan limits because it's a, generally speaking, short-term 1-year graduate program that might not be that expensive. I think that's a broad swath of certain programs, but then there's obviously a broad swath of other programs that on a per annum or in total basis do potentially require higher loan limits. So yeah, I mean, I agree. Having two categories, professional and graduate, which are really non-identifying of what's actually the fields of study underneath that, is somewhat arbitrary. And I do know that there is, again, some historical context of the professional categorization being fields of study where you need some type of licensure.
We could have like a business class and a grad plus and then an economy, we can have different.
But yeah, I mean, and this is I think the point you were making with the debt to income ratio, right? You don't need categories. You could just assign everybody based on whatever you're studying and whatever school you're going to and whatever degree you're getting. This fits in a good enough category. Take whatever you want. This doesn't. So you're going to be limited.
Yeah. And from my perspective, why would you not give out a good investment?
Yeah.
What's the rationale for restricting certain programs that otherwise would be a good return for both the student and the government?
Right.
And to follow up on my earlier point that maybe you'll be working your way through school, the other thing is that go work for a while and then decide to go back to school and help finance your own education that way. Because you're not going to be able to borrow as much one way or the other. And again, that could discourage people from doing it, or it just delays them getting the degree that they know that they want and that was going to make them in the job that they really want to be in. So there are lots of reasons why there would be a downside to just reducing the amount of investment in human capital. And this is trying to, I think, not necessarily just do that, but try to direct it in certain ways. But it seems like such a crude metric that there have to be more than two categories, even if it's not, a continuum. It's like the more ways in which you could group these loans based on the field of study and the type of institution and, the historical, return on investment from that, I think the better it would be than just two simple categories like that.
Going back to the debt to income ratio, the Department of Education recently proposed a new rule describing how they think schools should be evaluated when it comes to being eligible for federal loans. So I'm curious, can you explain what this proposed rule change is supposed to be and what we think the consequences of it might be?
Yeah, so in mid-April, the Department of Education issued another proposed rule, as you said, aimed at evaluating programs that use federal aid. This existed to some degree previously, so this is an update to an existing rule. The existing rule relied on two metrics, is my understanding: debt to income ratios and a earnings premium. So what that means is for programs that receive federal aid, or for students in programs that receive federal aid, looking at two things to evaluate whether those programs are putting students into gainful employment, jobs in their occupation, if that's applicable. There's other types of metrics they use for more general degrees, but two things. So the debt to income ratio is how much debt do those students have post-graduation relative to the income they're earning. And if it's below a certain threshold that they had assigned, that is a flag that it's putting them in worse outcomes. And then the earnings premium would be if your students that have now matriculated and graduated are not earning as much as a high school student in the same state, then that's again another flag that students aren't getting put into beneficial outcomes, the government would say, from those programs. So the new rule updates that to essentially remove debt to income ratios as a metric, and put more refinement on the earnings premium. So for baccalaureate degrees, you would get compared, the students who have graduated from that program would get compared to high school, or people with at most a high school education, ages 25 to 34 in the same state. If your median student from that university earns less than the median high school graduate in your state, that would then flag that as a poor outcome. So for graduate students, they would compare the median earnings post-graduation to the median baccalaureate earnings in the state, or potentially also the median earnings of baccalaureate graduates in the same field of study. So again, these are metrics you could use to compare the outcomes of students. But essentially the outcome of that is if you are not meeting those requirements in 2 of 3 consecutive years, they can take away your access to federal aid.
So I want to go to Nathan and Steve on this one, because it feels like you had 2 metrics that you were utilizing to try and optimize for whether or not a school is entitled to these federal student loans. We've moved now to 1. Any dangers, any red flags for you here on switching from one system to the other?
One of the concerns that I have is that, if you were looking at, is this a good return on the investment? What would this person have earned absent that degree? And there's a wide variety of incomes for people that graduate. Let's go with the bachelor's degree graduates, depending on all sorts of things. And I think it's just going to really hit certain fields of study more, because just achieving the median across all fields of study might be a pretty good outcome, depending on what it is that you're expecting from that kind of degree and what you would have earned without that degree. So I think it's still a crude metric, and getting rid of the other one doesn't seem obvious to me why that would make it better. But I think even the more you refine it and say, let's look at compared to the median, I think that's going to be problematic for some of the fields of study, and each of them, depending on what they study, they could be in different industries, different occupations, different work-life balance. All these things are going to affect what you're going to make. And it's like, okay, you got to produce beyond a certain level. Otherwise, we're not going to be able to continue to get federal funding.
Well, I just hope that survey's not the ag survey that your clients are needing to rely upon to set wages, which is too much interpolated and
yes,
and not specific.
I think it's going to be the ACS. Is that?
Yeah. And to the extent data is available, right, for graduate programs in certain fields of study, you don't have that many students in any given state. So I do think they are currently seeking comments on the best data sources to use for these sort of more narrow graduate programs in certain states that only have, let's say, 10 students. And so that information is actually privacy suppressed and you can't see it.
Yeah.
I do wonder what the incentive effects are going to be if it goes through on students who would go to a particular state and then go to another state to get work. Like, it seems like there's a lot of people who move after getting a graduate degree.
Yeah, and I think there's some again, crude limits on which median earnings benchmark they use. So if 50% of the students at that program then move out of state afterwards or are not from that state beforehand, they might use the national average instead of the state average or state median. So there's some crude metrics, but I do think that's still a national median wage of all high school workers is a pretty broad grouping of individuals.
The federal government has these locality pay adjustments for people doing the same work in different places. And some of the places, there are not a lot of individuals there doing particularly that job, but they use kind of an overall adjustment factor. It just seems odd to me that you need a bunch of people in that area doing exactly that. I'm not saying this is a good idea, but of all the things, that seems a little bit more. We could get around that by just saying in this state or this city pays 10% less than the national average. So we use that kind of adjustment factor. And here it's 20% more. Whether they're people that are doing the particular job or not seems like, not the most important thing. Just the idea that you would compare to the median, it seems an interesting threshold that you're going to have to achieve.
Well, at the start of the episode, Connor, I borrowed $50. What is the interest I owe you now? Just checking here real quick.
Has it been an hour?
It's been roughly, it's been roughly
So
an
we'll
hour.
call it an hourly interest rate of 10%. So I'll take my $5.
Oh,
That's
okay.
fantastic.
Jeez, that's actually pretty good. I thought he was going to double it or something.
No, I figured I'd be nice as we talked more.
Well, thank you very much for talking with us. And as these new changes go into effect, we'll certainly love to have you back on to talk about any of the incentives that people are responding to.
Lovely.
Well, that's been this episode of Significance. This episode's been brought to you by Edgeworth Economics, a leader in economic consulting, and with the help of our producers, Kimberly Krewald, Ryan Deal, and Brian McLemara of Brand Ready Media, with music by Armwell Lang. Thanks for listening, StatPack, and always remember to check your assumptions.